Yes. Good morning, everyone. This is Sandra Anker with Remax Plaza. I'm coming to you this morning with a real estate minute update on the home markets. And today my special guest is Brian Giangreco, and he's going to talk to us about the news that we recently heard about the Feds holding the interest rates. He's going to elaborate and explain to us what that truly means for us as the consumer and for all those interested in buying and selling real estate at this time. Brian, thank you for joining us.
Good morning, Sandra. Thanks for having me. I just want to kind of try to take this complex issue and break it down. So hopefully I can do this to you. So for you, excuse me. So the Fed Reserve's been buying about $120 billion worth of mortgage bonds and treasuries each month in an effort to keep interest rates low. Okay. So these purchases have, obviously greatly influenced keeping rates low over the past year and a half. So at their last meeting, which was on November 3rd, the Fed announced they'll start to taper or reduce those purchases each month. And because the Fed will be purchasing less, there is a potential risk that interest rates may not stay as low in the coming months. On top of that, the additional recent fears of rising inflation may nudge rates higher. So the current interest rates are still extremely low. That's what I want people to know. We got down as low as maybe 2.25% a year ago on a 30-year fix. Now we're probably close to 3%, the 3% range, which, historically.
Yeah, that's still phenomenal. Yeah.
Yeah, if you historically Google interest rates, very low. So now it's still a great time to buy a home or refinance your current mortgage and cash out. What we're seeing is a lot of people still can afford homes.
Wow, that's wonderful. That's wonderful news. Now a lot of people are confused by when they say they kept the rates at zero to what current interest rates are. Do you have any kind of information to show us what that truly means?
Yeah, no, I'm still confused about that rate. I've been doing this a long time. So let me see if I can put up a slide here. So can you see my slide here? So we created a slide. Really what I want our listeners to understand or kind of try to get their head around is, does the federal funds rate, I like this slide, does the federal funds rate affect mortgage rates? And kind of in a nutshell, the federal funds rate is a short-term rate that the banks charge each other to lend overnight. And so this is the rate most talked about by the media. When you hear the media say the Fed raised interest rates today, that's the rate that, that's the rate that's affected. So now, conversely, mortgage rates are more long-term rates. So again, the federal funds rate is a short-term rate. The mortgage rates are more of long-term rates that are influenced by the treasuries, like the 10-year bond. So for an example, in our slide here, if you look at the red bar represents the federal funds rate over time, back from 2018 all the way through November 2021. So when you hear rates are at zero, that's just the federal funds rate. That's not the 30-year mortgage rate, which is actually represented in our graph by the blue line.
Okay.
So I kind of just wanted to get that out. I know this is kind of a complex topic, but it's a big misunderstanding, from really the media and a lot of consumers, because it's just a complex topic. So I hope that helps out a little.
Thank you for sharing that. That is so helpful. Well, I appreciate you sharing some light on this complex subject, and I look forward to the next time we can speak more about lending and mortgages on our next update.
Thanks, Sandra.
Thanks, Brian, for joining me.
Thank you.
Bye-bye.